Your 401k is not only going to be your largest asset that you accumulate through your working years, but it also is going to be one of your most powerful financial tools. Find out today how you don't want to miss out on opportunities it can provide and what that looks like for your future going forward. Welcome back to Consider This Program. I'm your host, Grant Soliven, and with me today I have Rheaume, our Director of Financial Planning. Aaron, thank you for being on the show this morning, my friend.
You're very welcome, Grant.
You know, one day I'm going to have to get into the vest game like you. I mean, you have an incredible vest game. I tried to use this pullover sweater, and I don't look nearly as good as you. You have to give me some pointers when we're done with this. But ladies and gentlemen, thank you for being part of the show this morning. We're so happy to have you here. Like we talked about in the beginning and at the start of the show, we're going to talk about getting the job done. And getting the job done specifically on your 401k. So, Aaron, it is the largest vehicle that we have access to because, number one, it's payroll deducted. So, getting into the discussion, let's start with what is a 401k?
Mm-hmm.
How should you be using it? And how does it become your largest asset over time? Let's kind of start there and run with that.
Sure. 401k is just an IRS code for the type of retirement account, usually employer-sponsored. And you may have some other accounts out there like a 403b if you work for a nonprofit or a school. So just a code or a name for a savings plan that's offered by an employer. The base benefit of that is really figuring out what is unique to your 401k plan. Employers have different matching options. They have different vesting schedules, and we can get into a little bit of that in detail in the show. But it's just figuring out the nuts and bolts of what your options are inside of your employer-sponsored plan.
100%. And so when kind of digging into that and diving into that, you know, when the code was enacted, what's interesting, and you and I love history. I think that's why I think you, Joe, and I share that interest, and we love talking about it so much together. You know, when you take a look back at what 401ks were before what they are today. So if we rewind the clock, the ERISA code came out and essentially said, here's something that you all can do. And they were talking to particular employers. And those employers said, love it. This sounds like a wonderful tax opportunity to defer some of those taxes that we're paying. You know, obviously income owners or business owners have, generally speaking, higher incomes depending on the situation. And then, unfortunately, found out that those business owners weren't sharing the benefit with their employees. And so the reason why Aaron brought up, you know, there's so many letters, there's so many rules and regs in this plan. You got to know what you're working with, and every plan document can be different. It's because of that. The Department of Labor is trying its best to protect the employee, those who are working for an employer, to save their money. And so, Aaron, a big question we get inside of 401ks is, what is a vesting schedule, and why does that matter? And particularly, let's focus on inside of a 401k, we get a lot of questions where it's like, gentlemen, I'm getting close to retirement, or, hey, I have an income need. Should I pull my money from my 401k? No, and why would that be a good idea, and why wouldn't it?
Okay, so two questions there. One was on what is a vesting schedule, and then what if I need access to funds inside of the plan?
Correct.
The vesting schedule is really a way to describe that would be the time that the employer will allow you access to the company match. So it's really designed to keep you with the company. And so generally you have a 5-year vesting schedule, Grant, to where if the employer makes a match towards your contribution, if you were to leave employment, you're not going to take that full portion back. And so after that vesting schedule ends, when you become 100% vested, then you can take 100% of the employer match with you.
And also, it is useful to know that because it also pertains to loans, hardship distributions, etc., which
Right.
Let's go into those for a second now.
Yeah, so loan is really just borrowing money from yourself inside of your 401k plan. Many different options, many different ways those are set up through the 401k and through the employer itself. Some employers may not offer loans. Some plans do not. We don't offer them inside of our FEG plan.
Correct.
But some employers do, and so that's where you're borrowing from yourself at a stated interest rate inside of your plan document, and you pay yourself those payments back over time. One big thing that people make a mess up on is if they leave employment and they do not pay their loan off, then that is fully taxable.
And here's what's interesting, folks. I want you to catch what Aaron just said. It's fully taxable in the year that you left employment. So we had this situation. I don't want everyone caught up in this. We had an individual who retired. They were so close to paying back the loan. They only had, I think, a couple $1,000s left.
Mm-hmm.
They retired, didn't pay off the remaining payment because those payments have to be made through payroll deduction according to some plan documents.
Correct.
And because the individual didn't pay that back, they ended up having to write a check for an additional $50,000 of income in that year because that was the amount of the original loan. So these things can get hairy. So what Aaron's talking about is you never really want to be careful when taking a loan or trying to take a loan. Yes, you're paying yourself back, and I know there's a lot of information out there on YouTube and the Google suggesting the best ways to do this. But if you're going to enter that situation, make sure it's the last resort, and more importantly, make sure that you understand the rules and your timeline because that can come back to bite you. Now, there's another one, Aaron, and it's essentially a hardship distribution. How is that different from a loan?
Yeah, hardship distribution allows you to take money out of a plan without penalty. And there's a number of different hardship distributions that you can take money out of a plan. Another way you can take money out is if you are potentially going to purchase a house, correct? Sometimes you could take money out of the plan for that.
Depends on the plan document.
It really depends on the plan document. Where we see a lot of people leaning towards is what's called a in-service non-hardship distribution. That's where you're able to, if the plan document allows it, take money out of your 401k plan, move it to an IRA or a Roth, depending on how you have your 401k set up, and it allows you to be able to move that into an IRA or a Roth vehicle to where you're have a whole lot more investment choices. You're not limited to the investment choices inside of the 401k plan. Correct. And sometimes it's a benefit to do that.
100%. And again, and this is where, I apologize if we sound like a broken record, but remember, you can't just make decisions based on what you hear, especially even on information from our content and our show, because we keep going back to it, and I hope you're hearing that, is you have to understand what's in your plan document. Now, the Department of Labor has written down all the rules and regulations on what can be done. That doesn't mean your particular plan is going to do all of that. Correct. For example, we don't have loans. Other rules have changed with non-hardship distributions. And again, and here's another one. If you took out a distribution because of COVID, because remember we opened up because of COVID access in hardship distributions, we laid out more parameters for individuals to access more money because of the financial hardship. And if you did that, remember, you have 3 years to pay back the taxes. You didn't have to do it all at once. Mm-hmm. And so make sure you're working with a planner and a CPA who understands that, because if that's the case and you were able to take that out or other things, make sure you have the right tax plan in place to be able to be prepared for that. So, Aaron, we talked through the vesting schedule, what the 401k is. You brought up investment options, which I'm glad you did. So we'll talk more about that in the next segment here. But remember, one question I've gotten from families, and we'll cover it here, is, Grant, why are there why are limited options, or why are there limited options in our retirement plan? Why can't we just have the whole world of investment options accessible to us? My plan's at Fidelity or Vanguard. Why am I limited to just their mutual funds? Why can't I have index funds or other ETFs, etc.?
Cost.
It comes down to cost. It also comes down to research.
Sure.
A lot of custodians have done research and found that in order to enable and essentially proactively help an individual become successful in a retirement plan, they found that if there's more than 13 investment options, most people freeze and actually don't even do anything. They'll leave it in the default. Yeah, they'll leave it in the default investment option for simplicity's sake. So don't think the companies are out there to get you or they're limiting you. They're following research, and to Aaron's point, cost. It takes a lot of resources to run a 401k plan. There's a lot of admin costs. There's a lot of investment cost. And so that's why it's also hard when reviewing your 401k and trying to understand what your true expense on a plan is, because there's so many documents that go into what that looks like. And oftentimes it's almost, for the common investor, impossible to find that cost because there's so many layers to it. Now, wrapping up, contributions. Really the power that makes the 401k the 401k. And now what's interesting, Aaron, is Roth became a thing in the early 2000s. Mm-hmm. And Roth 401ks really didn't become or actually even accessible in the 401k plan space until 2010 through 2012, which is finally, it was very interesting to me. And what's interesting beyond that is still 40%, I think if that's a new number, if I'm correct in the statistic, nearly 40% of plans still don't have a Roth 401k option. If that's
ludicrous.
the case, I think it is ludicrous too. If your 401k plan does have a Roth option and your tax situation allows you to utilize the Roth, please do so. Taxes are on sale. You've heard us talk about on the show time and time again, right? Taxes are on sale. We're in the lowest tax bracket rate we've ever been in. Use the Roth to your advantage.
Yeah, just to make a quick explanation on that. If you're in a 10 or 12% tax bracket, there's really no reason why you should be deferring to the tax deferred bucket. So that's a topic for another conversation, but just know where your taxes are, and you shouldn't be deferring at that point.
100%. And if you're under 50, remember your contribution got bumped to $20,500. If you're over 50, you get an extra $6,500 catch-up. So a lot we can cover on this, and so we'll jump into more on this in the next segment. But again, if you're looking for a fiduciary to help you discuss more of these options, sign up for a Next Steps meeting. You can get that complimentary through Brittany. Call us at 800-928-4001, or reach out to us at yourlifeafterwork.com.